Good day, fellow investors. In this video, I just want to comment on 5 topics that I have seen a lot of interest in the comments and that are really interesting also for me. So let's immediately start with the irrationality surrounding growth stocks over the last 12 months. In this overview of European stocks, we also discussed Just Eat Takeaway. And if we look at Just Eat Takeaway over the last 5 years, it went from 24 to 100 something, 110, and then over the last 2 years, year and a half, it went from 110 to the current 18 for an 85% decrease. That's an incredible decline. 83% is a lot, but what I want to discuss is really this. So how can anyone tell me that the market is rational when a company is valued 24, then 110, and then just 18 months later 18? So how can something change that much in value in just 18 months? This is okay, irrational, but this is too irrational, and this really shows how the market works. I think that there must be value, and there will likely be value for those that understand also these growth stocks and picking them up, because from overbought, it quickly goes to oversold. And this happens anytime, all the time, everywhere in the stock market, because people have this one-way thinking mentality. It either goes up or it goes down. There is no in-between for 95% of the market's population, and that's our big opportunity. Of course, maybe not Just Eat Takeaway because of their very risky business model, so it's a binary bet. It will either scale and do good, or it will go bust by burning money and losing money forever. That is the name of the game. However, the focus here for me is really market irrationality. If we look at Zoom, boomed here in the pandemic to 559 and then down to 100. These are huge differences, 80% down, so really crazy. But I don't know what people expected. If you look at this, the market cap is 37 billion, thus it was 150 billion. So at some point it comes to fundamentals and then it simply reverts. And I keep telling people about fundamentals, but nobody can tell me that markets are rational. So that's really pessimism and optimism, greed and fear, and that's something we have to try to detach ourselves and then analyze the fundamentals and see how those fundamentals fit us. That's investing, and that's why I really wanted to emphasize the craziness of the markets by discussing these growth stocks. Now, we also discussed Unilever, a company that I said it is okay, I hated the management, now maybe it is better but not that better. Nevertheless, it has a strong brand, and look at how strong the brand is. I just received this package. Of course, I'm half Dutch, and if you want the best pindakaas, it is from Unilever Calvé, of course. So very interesting, very strong brand. I already opened it, but I'm not eating that much anymore, but I grew up on this. So that's something that's there, that's strong, but when it comes to investing, it's not just about the brand. It's also always about fundamentals. If we look at the stock price, you can see that it compounds over time, so the trend is there, but it is negative, booming optimism, negative. This didn't do anything for 15 years, which is really crazy, except for the dividend. Then it booms on growth and optimism, then people are willing to pay whatever price for it, and then it goes down again, and it is still, let's say, a little bit pessimism, but still a lot of potential down given what's going on in Europe. And then when you think about it, the market cap is 114 billion and the free cash flows are around 6. So that's price to free cash flow of 20. 20 is okay. You will do okay long term, you will get the dividend, you will do okay, but it's not remarkable. Remarkable would be 10. And it happens here and there, even with great brands. And that's what we as investors are looking. We are looking for great opportunities, not just good opportunities, not just good businesses with great, strong brands. We are looking for good businesses at fair prices. 20 is not a fair price in my opinion. 10, 8, yes. 20, not. And that's what makes the difference between getting this in your portfolio, so really, really good, or getting this in your portfolio. That's not something I strive for when it comes to investing. Now, another topic that I want to discuss, it's again based on that irrationality, panic, greed, and fear. And this is Michael's comment here discussing how his down target for the S&P 500 is 1,500 points. That would be something really remarkable if we go from 4,600 to 1,500 points where we were 10 years ago. So not that far into history, but everything that happened over the last 10 years should revert. And what happened in the last 10 years? Well, the Fed's balance sheet went from 8 billion to 9 billion, so let's say 10x, so really a lot of injections of money into the system, and they are now trying to tighten a little bit, but you don't even see the tightening here. So it is just mostly flat, and now they have even increased again the money into the system. It is not possible for them to tighten. And here we come to something that I don't think that will get to 1,500 points, because what usually happens is currency sacrification. The currency gets debased because it would be too much pain. If you just look at the assets distribution of wealth in the United States, this is from 2016, but it's irrelevant, it's not precise, it's more just for indications. And look at the wealth. Most wealth is concentrated in the top 50% of the population, and look at where your wealth is. So green is home equity, so 75% of the population have most of their wealth in their homes, so with mortgages, with everything, and in retirement accounts that is invested in the stock market and unfortunately bonds. So when it comes to the Fed and politicians, they will focus on this. They will focus, okay, what is the wealth of the people that impacts also the spending? And if the S&P 500 crashes, and if home prices that are the core of the wealth go back to here, just here, then it is absolute pandemonium, as it was the case after the great financial crisis. Less wealth, less spending, huge problems. So the Fed will always try to hit the 2% inflation to ease and keep pushing that wealth higher and higher, which leads us to the next topic that we discussed in Seth Klarman's video about the Fed chickening out. Seth Klarman says that it is very likely that the Fed's discussion now is strong, but that they will chicken out and then let inflation go, let stocks and those assets go higher, because mentally you will feel better for the S&P 500 to stay at 4,000 points, even if inflation is eroding the real value behind it, even if your purchasing power will be lower because of inflation. Now inflation is 10%, yes, you feel it, but it's not like that someone takes out 10% of your salary. That's very important. So the Fed will likely chicken out. They're trying to play strong now, but if they really impact those markets, if they really go for, okay, 10% interest rates, 10% inflation, S&P 500 to 1,000 points, absolute destruction might follow, and that's why they will likely chicken out before. Anything can happen, but it's likely that they will chicken out before. So I don't have such terrible projections about where stocks will go. And also we discussed Ray Dalio. He's thinking how central banks can do whatever they want, but it is all about productivity, and central banks can't increase productivity. So you probably never lived in hyperinflation, but I lived through it twice in my life with two different currencies. So printing, and once you get high on printing money, there is no other solution to it. So printing, and everybody thinks that by printing money you solve everything. Unfortunately, it's not the case. You solve things by increasing productivity. Look at the billions I have, but that's something the Fed doesn't do, and actually it's the wrong focus now when everyone is focused, oh, the Fed will save our behinds. No, your productivity, so sitting on your ass and working, can save your behind, nothing else. But that's something we'll keep discussing over time with the videos. And then just another thing to finish. A lot of you, when we discussed these 10 stocks, asked where do I get the buys and sells from great investors. So I find this website, Stock Circle, and then you can type in whoever you want. Let's do Bill Ackman. Click here, and then you can see their top portfolios, and if you click, you can see here what they own, when they own, all the other related investors, and you can also see what they are doing with the position in a graphic way. You don't spend time by going through those 13 Fs, and you can see here, okay, low, Bill Ackman sold a little bit, and now we'll see whether he'll buy more or not, but most he bought pre-pandemic and then slowly divested, and that's his idea. So from this, you know, okay, it was a buy at 120 and lower. Now it might be closer to a sell, just from Bill Ackman's perspective. So Stock Circle is the name of the page. I'm not affiliated, don't earn anything just because you asked. So thanks for watching. If you're interested in my portfolios, check my stock market research platform. So feel free to check it out. There is a 28-day money back guarantee. Check my other videos. Thanks for watching. I'll see you in the next video.